Our next guest is optimistic for the new year. You got to be kind of your stock investor. Jeremy Bryan is portfolio manager at Gradient Investments. And now, okay, let's just see this market outlook. I don't know if this was three-stock lunch, Jeremy, so I got to get my segment straight. What would your three-stock lunch be comprised of? What's on the shopping list on a day like this?
Yeah, so we're really looking at things that, there's a lot of stuff in the markets with valuations rising here that have gone from 20 times earnings to 30, 40, 50 times earnings, right? That's the stuff we're trying to avoid here a little bit. For a three-stock lunch, we're trying to find the stuff that can still grow, but that valuations really haven't stretched like that. And I'd start with Alphabet as the first one in that contender list. It's going to expect it to grow it again in the double digits for the next couple of years. And despite almost a 40% return this year, it's still only trading at about 23 times earnings. So It's right in line with the market because of all the regulatory stuff and the other overhangs that are potentials on the stock. Yeah. We see it as more of an opportunity to continue to buy a stock that's relatively cheap.
It's amazing that you can have a company come out with a quantum, the quantum companies are up 1,000% and Alphabet's trading at 23 times earnings, and they have Waymo and they have Gemini. I mean, it's so interesting how it's not a 30 or a 40 multiple kind of company.
Exactly right. And the other one that I would say is YouTube, right? If you're just looking at saying media growth, where is media growth going? Well, if you're talking about podcasts and you're talking about those things, everybody's going towards YouTube. So those are the kinds of things just in and of itself. You could make an argument with Alphabet that even if it gets broken up, the sum of the pieces might be more valuable than it's currently at right now.
Sure.
I think that's what's really interesting about this company.
22 times. Real quickly, Jeremy, about today, and then we'll move on to some of the other things we want to talk about. But do you make much of the fact that we're having kind of a reversal day where all the stuff that won this year is down? I mean, is that just year-end rebalancing? Is there something more to it?
I think it's like 4 people are trading today. I really don't think that there's a lot
and they all
to
have
take
acne.
from it, especially like you said, the pre-Christmas rally was one of the things. We're just kind of offsetting those things. I just don't think that there's a lot of activity and a lot of things you can take from these movements. These year-end movements can get a little funky, so we don't tend to put a lot of stock in it. But if a stock gets overdone based upon these year-end movements, we'll take advantage of that for sure.
Jeremy, I have a question here. When I just want to read this. When Kelly led into this segment, she talked about across the board, big tech, small cap stocks. I have some fixed income in my portfolio. And yet when I look on the stock side of my portfolio, I feel like they're affected by interest rates too. I feel like I have interest rate exposure in the stock market and in the bond market. I don't want that much exposure. Is there any way people are getting around this now? Especially like if you're in the small caps, yields go up, your small caps go down. There's like too much interest rate exposure.
Yeah, I think the central theme of that one would be you've seen what's worked when interest rates are rising, right? People flock back into tech because they don't care, right? They can do whatever they don't need to go out and raise debt. They don't need, they don't need high CapEx. They can do whatever they want to do because they have massive cash flow generation. So I think that's where people circle back into when interest rates get a little frothy, if you will. So that side, I think that's what we've seen working, and that's what people's playbook has been. At these levels, I think it's worth taking a look at some of the stuff that's been more damaged by that interest rate trend rather than flocking more into the ones that have benefited from it.
What's an example of that, Jeremy?
Companies like waste companies, right, is your industrial companies. Company like McDonald's is another one that just kind of hasn't done much. Now, I don't think that's affected much by interest rates, but if you look at like a Waste Management or Republic or Waste Connections, these kind of companies have come down over in December. Now, there might be some economic activity slowing in there, but I think part of that is dividend, recurring, interest rate kind of stuff can affect them a little bit more. But in my opinion, that's becoming more opportunistic as a result of those, falling a little bit.
Yeah. What else?
The other one that is a little controversial right now, but we still like it a lot is United Healthcare. We think United Healthcare is an opportunity at this point right now. At the end of the day, it's going to be very difficult to displace these companies. There could be some adjustments that come as a result of a new administration coming in, but I doubt that single-payer healthcare is on that docket. So from our side, we think the public insurance or the private insurance companies are still going to be very valuable. They're still going to grow 8 to 10% per year, and you now have, based upon this recent reduction in United Healthcare, a really good opportunity to enter in a really good company at a cheaper price.
Jeremy, what might happen happen on the policy front that would actually kind of make you say, okay, wait a minute, this gets really to the heart of this business model? And I ask as someone who's kind of hoping they can come up with something to get to the heart of this. I mean, it's the billing, it's the whole incentive structure in healthcare, high levels of regulation, so on and so forth. I mean, is there anything in the works on that front, you think?
Not, here's the thing is that there hasn't been a magic fix for health insurance in 25 years, right? From a perspective of just getting, cheaper care to the consumer that, it avoids middlemen and all that stuff. We've been talking about that for a very long period of time. I would love to see some fixes too. The healthcare system, when we're spending the most and not getting the most optimal care, that seems to be a problematic system.
By the way, if they do make them divest the PBMs, would you be more bearish on the stock or not care so much?
Slightly more bearish, but they just basically tabled that for this, to get the budget line across. So from that side, I mean, there doesn't seem to be a lot of what I would call forthrightness and aggressiveness about taking care of those types of things, especially since the new administration coming in probably has other incentives and things that they're going to concentrate on at the outset. So this is a tough problem to tackle. Our elected leaders can try to figure out that problem, but until then, I think the insurers play an essential role within that space. And I think that right now, especially, you can buy them at a bargain opportunity.
Jeremy, Bryan, thanks for joining us. Appreciate your time.